Hello everyone, ladies and gentlemen. This is Anton Jarkov, the proud author and founder of the amazing Eyestock project. Today, we will delve into a very interesting idea that I recently discovered for all of you, the company Zoom. So, for those who are new here, and probably everyone is new since this is the first video on the channel, I want to tell you a bit about what will be in this video and provide some context about the channel and what you can expect in future videos. In this video, we will thoroughly and comprehensively analyze a stock from the American stock market in great detail. This is Zoom Video Communications, a leading provider of video conferencing solutions. And then, using my own example, I will show how I use this knowledge and data in a specific case of buying options on this stock to demonstrate in a detailed manner. So, let's figure out what we have. We have Zoom Video Communications, a company founded by an American entrepreneur with Chinese roots in 2011. This company originated from Cisco. In 2019, the company went public with an IPO and entered the market very successfully. Why? Because the COVID-19 pandemic began. This played into the company's hands. Zoom almost immediately became the embodiment of working from home, remote work, and the ability to continue working even when you're stuck in an apartment and can't do anything. During the pandemic, Zoom's role became even more crucial as it allowed people to stay connected with their colleagues, attend virtual meetings, and maintain productivity. The company rapidly began to grow, specifically in terms of clients, and expand its operations, revenue, and stock prices. But it must be said that it still remains a company with a capitalization of only $19 billion, which is relatively small compared to industry giants. Interestingly, the company grew from about $65 per share to an impressive $500 per share during the pandemic, showcasing significant growth. Meanwhile, revenue increased substantially, but net profit did not follow the same upward trend. So, it turned out to be a kind of pump and dump on the American market. And then, when COVID-19 began to subside, Zoom's stock prices also quickly plummeted to $60, and it seemed like the end of the story. But no, a miracle happened. In 2022, the company showed excellent financial results, with significant revenue growth and increased profitability. In the 2023-2024 quarter, the company reported just magnificently, with record-breaking earnings and impressive market performance. Now let's take a closer look at this. So, here is the map of the American technology services sector, which highlights the key players, market trends, and emerging technologies that are shaping the future of this dynamic industry. You see giants like Microsoft, Google, and Meta here, that's all clear. But today we're talking about this small square, Zoom, just $19 billion. And here, in fact, are the quotes. Once again, prices spiked sharply, then started to decline. Indeed, I am a big supporter and fan of value investing, and significantly so. I am fond of such ideas, meaning this is a business that has already established itself, shown certain dynamics and results, and there is something to analyze. Essentially, we are following in Buffett's footsteps. And now we see that when the hype around the stock has died down, the froth has settled, and we can see that the business is actually making money. And let's see how much he actually earns. According to the results of the fourth quarter of 23rd year, according to the results of the first quarter of the 24th year, in the report, it will be listed on the company's website as the fiscal year of the 25th year. It is announced that the company earned total revenue of approximately $114 billion overall for the quarter, which represents a 3.2% year-over-year increase. Moreover, 55% of the total overall revenue, or $632 million, came from corporate clients, respectively. And here we see, as you can see, an overall 5.3% growth in this particular segment. And online revenue, that is online earnings, amounted to $475.5 million. This is 40% of the total revenue. I would like to highlight the customer base, which Zoom reported as 191,000. Clients who pay Zoom under signed contracts include a significant number of large clients. Specifically, there are 3,183 large clients who each have checks exceeding $100,000. In this particular segment of our client base, we are anticipating a growth rate of 8.5%. This growth highlights the increasing reliance on Zoom services by large-scale enterprises. As for the revenue, after a thorough analysis, we determined that it was consistently good, showing stable and positive trends throughout the entire first quarter of the year 2024. This is a detailed overview of how Zoom, a major player in the video conferencing market, is currently performing. I prefer to conduct an in-depth and thoroughly detailed and comprehensive analysis of the competitive market from the perspective of Michael Porter's 5 forces. That is, there are certain barriers to entry in the industry, and in this case the barriers are actually low. That is, indeed, any company that has the technology or financial resources can easily enter this market. However, the process of establishing a recognizable brand identity and launching a comprehensive large-scale advertising campaign to ensure that the market is aware of and accepts your presence is an entirely different and more complex challenge. This is the so-called large-scale adoption. Achieving this is very difficult and requires huge investments, but Zoom managed to do it thanks to the pandemic. In other words, people came to them on their own, actively and enthusiastically growing Zoom's audience. Economies of scale, significantly. This is the next parameter by which we will specifically evaluate the entry of new players. Zoom has economies of scale, but they have already been achieved. It has already been achieved. Why? Because the gross margin figures are stable from quarter to quarter. We will see this a bit later. Brand recognition and customer loyalty are exactly what competitors find extremely difficult to achieve in the competitive market and maintain over time. Let's talk about the competitors. Today's Zoom service customers actually have a lot of choices. There's Microsoft Teams, Google Meet, and Cisco's WebEx. Plenty of options. Meet and Cisco's WebEx too. There are many different options available, and even Skype, for example, can provide a certain level of competition in various aspects. However, Zoom is more advanced, including video conferencing, faster, friendlier, and it has already become a brand. Some people say, let's Zoom, without necessarily meaning to use Zoom itself. Yes, that's what the competition looks like. We understand that it's quite a competitive market in which Zoom has managed to secure a large number of clients, including many corporate clients. Both various large companies and prestigious universities have adopted it. Zoom is excellently used in the field of online education by various universities, successfully managing to build a significant client base and achieve a revenue of $1.1 billion. Here is a very fascinating slide. Let's take a more detailed, substantial look at it. This is the quarterly revenue, and we see particularly notable growth here. However, the growth in operating profit and net profit does not match the revenue graph. We especially see that the situation was dire in 2023, especially in the first quarter of that year, as we faced numerous challenges and difficulties, making it a very tough period. There was a net loss here. Why? Because during this period, the company was actively investing in R&D, which stands for research and development, specifically in its advanced AI technologies. These technologies are designed to allow the company to incur significantly lower costs and operate much more efficiently in various business operations by the year 2024, while spending less money and ultimately achieving a net profit. Let's take a look at the key, important profit and loss figures from the detailed and comprehensive report that we managed to obtain. This is the gross margin, 76%, which is a significant figure. The operating margin is 17%, which is also noteworthy. The numbers are not wow, but very solid for a company that has been heavily sold on the stock market, and the net profit margin is 18%. Let me remind you that according to Eyestock's philosophy, our benchmark is 20%, so just a little more, and this will be a benchmark company in terms of net profit margin. This means that the company is performing well and is on the right track to achieving its goals. Another important metric, which we take partly from the cash flow statement and partly from the income statement, is the quality of earnings. Well, Zoom's quality of earnings is absolutely, undoubtedly, remarkably, extremely, undeniably top-notch. All the profit in the report is confirmed by operating cash flow, even twice. And this perfectly provides a margin of reliability for the company. Here are Eric Yuan's statements following the first quarter results. They are actively implementing cutting-edge AI solutions and have developed numerous collaborative platforms based on advanced AI technologies. Eric Yuan elaborated on the company's strategic direction and future plans in a detailed manner. All this will definitely at least maintain the current audience and at best significantly increase it. In summary, we thoroughly examined and understood Zoom's competitive environment in detail, and we also took a comprehensive look at the company's revenue streams and the various sources from which it generates its income. Now, let's take a brief but comprehensive look at the details of the company's balance sheet to gain a clear understanding of its overall financial health. It must be said that the company's balance sheet looks very solid, $10.3 billion in assets. Moreover, the assets mostly consist of cash in the account, which is a highly liquid form of asset. This means that the company has a substantial amount of $7.4 billion in cash reserves, which provides significant financial flexibility. And assets minus liabilities essentially give us equity. Equity grows along with assets, which are $8.3 billion without long-term debt and liabilities. What I personally think is indeed very excellent. Here it's indeed ambiguous, by the way, we'll come back to this. It's excellent in terms of debt that, with high interest rates now, Zoom won't be spending and paying high interest on loans, and therefore not having to worry about it at all. This gives us a debt-to-equity ratio of 0, which is a key metric used to assess the financial leverage of a company. The current ratio is current assets divided by current liabilities, which is currently approximately 4. This tells us that the company is indeed exceptionally resilient and remarkably stable, both in the long term and in the short term. Now let's move on to efficiency. Here, Zoom has some minor issues, but nothing major. Why? Because the return on equity, or ROE, is only 12%. That's a bit low, unfortunately. Yes, it's a bit low indeed. And here, Zoom's management should consider that it might be possible to increase this figure through market borrowings a bit later and bring it up to impressive numbers like 20%. Additionally, considering various strategic approaches and carefully evaluating the potential benefits could significantly increase this figure in the near future. However, the ROIC, return on invested capital, is 47% for Zoom, a solid figure. The capital growth is 47%, a solid number. If we look into the company's report, they provide guidance. That is their estimate of future revenues and profits for the second quarter as $1.14115 billion in the second quarter, which is comparable to the results of the first quarter, providing a detailed analysis of the results in both quarters. This suggests that Zoom is no longer a story of explosive growth, it's more likely a value story, and in my opinion, the market doesn't understand this and undervalues it. We're talking about a value investment approach when we've found a good, profitable company that's undervalued by the market. So we understand that the company is good, right? Let's visit the company itself again in our Zoom service and explore its various departments and see how they operate. Right away, we see that the company's rating is 113. This is very good. Excellent indicators in profitability, balance, and efficiency. The only thing missing is absolutely stability in growth rates. And now we move on to the valuation section, which shows how undervalued the company currently is. If we look at the median historical P/E values, the upside growth is 319% at the current price of $59. At the current price of $59 USD, at the current price of $69 USD. How do we use this information exactly? How do I personally use the information? We received two components. The first component is the issuer's quality, 113%. We say this is high issuer quality. The second component is undervaluation, which means that the asset is priced lower than its intrinsic value. If you look at the chart, everything below the green line is a bonus from the market that should be taken advantage of. The third component is technical analysis, which involves studying past market data to predict future price movements, and I suggest we now move to trading. This is what the quotes look like on the weekly time frame, where each candlestick represents 1 week of trading activity. Wild growth and wild decline are phenomena that occur in various contexts. It might seem like there's nothing to make sense of here, but the whole point is in these candles from the last week, which show significant trends. So, what do we see here? Let's remove the unnecessary elements. Indeed, we have now successfully formed a range of values, in which predominantly market participants buy by delta, and I formed a position 2 weeks ago differently. Based on these estimates, it already seemed interesting to me. Now the market might make a false move down, shake out the players, and I expect a rise up to $90. How am I working out this idea? How am I working out? I am currently working it through an options trading call at a strike price of exactly 65. We are currently using a third-party application, which I really very much like. The tool, named OptionStrat, is specifically designed for options trading. We can see the detailed profile of our trading activity. It looks like this. If I am definitely wrong, and I chose the December expiration of approximately 190 days, the loss on the trade will be about $1939. If ZOO does go in this direction, then indeed roughly around $5,577 will be approximately the profit. Indeed, the chance of profit to close this transaction is about 21%. This deal is very risky on options. Therefore, I must say that this video is not an investment recommendation. This is just me basically demonstrating how I actually utilize our service in action, so to speak. I take on increased risks. It is important to still select your risk management parameters based on your own specific financial goals and personal risk tolerance. That's all for now. The first part of the video is definitely done. When the deal progresses, I'll absolutely record another video and we'll see how this idea turns out. Thanks everyone. Bye.